These banks are next to fail. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, we have an urgent warning as a leak report now exposes 8 banks on the verge of failure. And if you're wondering what we're doing in the front of the Federal Reserve building today, well, we're making a case that they're going to be headed back to zero in a big way because the stresses that are on the banks right now are mounting, as you're about to see. Let's over to CNBC, where we picked today's story up with a headline: WeWork just warned it might fail, signaling commercial real estate is in serious trouble. And this is actually was not even showing up in the reports. It's just how severe that the problem is in commercial real estate's about to be. And WeWork is raising the alarm here in a big way. As a result of the company's losses and projected cash needs, combined with increased member churn and current liquidity levels, substantial doubts exist about the company's ability to continue as a going concern. The shared workspace giant said it could only stay in business if it improves its liquidity, meaning cash, and profitability over the next 12 months. Its bosses plan to lower its rent and tenancy costs by restructuring and negotiating better lease terms and boost its revenue by attracting and retaining members. And of course, what we're seeing is this story is repeating over and over. Well, if we just restructure people's debt, the economy will turn around in time and everything will be okay. We're going to see that happen in China. We've already seen that happen with the U.S. banks. As we're going to make the case in a bit later, there are more that are going to get on this list of potential failures, and when the shoe does drop, we're going to see a lot more banks fail than anyone can imagine. And the problem will all stem back to, is the economy actually going to grow in the second half and rebound? Well, we're going to make the case of why that's not going to happen at all. And here you can see one of the reasons facing a problem for the banks, the economy, and companies like WeWork is there just isn't enough money. This is the M2, or the money supply, that looks at money in your checking, savings, CDs, and all sorts of different accounts to try to assess the pulse of how much money is in the system. Well, one of the problems is it's contracting. And what that indicates, which is extremely rare, we haven't seen such a contraction since the Great Depression. But what this means is there's less money in the system. It's going away, because in a debt-based system, I want you to remember that when debt is paid off, money is removed from the system. All that stays is the interest. And of course, you look back to these low or zero interest rate policies, that means money gets to go away in a big way. And so what happens now with companies like WeWork, we see this in the banking system, everyone's starving for liquidity. The problem is there isn't that much. And when the music stops, there's going to be failures, and lots of them. Excess supply in commercial real estate, increasing competition in flexible space, and macroeconomic volatility drove higher member churn and softer demand than we anticipated. In other words, there were just too many available commercial spaces relative to demand last quarter, something that's not changing anytime soon. WeWork's rivals also fought hard to win customers, but faced economic headwinds as well. So here we're seeing this repeated story of commercial real estate is there's just too much open space available and not enough demand to fill it. And what's going to happen as these loans come due, the banks are going to have to deal with this in a remarkable way. They're either going to have to write down the value of the building, which nobody wants to do, and the banks don't have the capacity to deal with, or you're going to see foreclosures and the banks are going to get stuck with these loans that they have, again, no capacity to offload. The only question is, when's the Fed going to run to the rescue? Well, we know they will at some point, but not until things get bad. Moreover, a combination of higher rates and remote working boom have pushed down prices of offices and other commercial spaces in the city. The blow to asset values, which will be a huge problem for the banks, and the failure of several regional banks this year have had smaller banks pulling back from lending to commercial developers. The upshot is the industry is navigating steeper debt costs, reduced access to credit, and big declines in the value of their properties, not to mention the prospect of a wider economic downturn or recession. And so what this is telling us is we're kind of in the calm, we're kind of in the middle between the next storm, because right now everyone's saying, well, look, everything's okay. But one of the problems the banks face is they haven't seen a lot of these loans come up for renewal, and it is coming in a big way, and there's nothing they can do about about it because either they write them down, which they have no money to do, or they take them back in terms of a default, and they're going to get stuck with them because, again, we've seen some of the studies already. The sales price is down, 50, 60% of these buildings. The banks have no capacity to absorb that, leaving us the only question is how many will fail. Well, we'll get to this new report in a bit that says even two big banks that you wouldn't even guess, have made the report. And here we can see why commercial real estate prices are indeed coming down as a net percentage of domestic banks tightening standards for commercial industrial loans to firms of all sizes. That is shown in blue, and anytime it's tightening, it's above that horizontal black line, and you can see commercial real estate prices in red shown on a year-over-year rate of change. So as banks tighten lending standards and they create less money in the system, asset prices tend to fall. We see that here during the global financial crisis. We see price growth just briefly contract during the pandemic, and we're starting to see it now. And the notion is that these prices can't go down. The reality is we're already seeing them go down, and this is a big problem for the banks who are trying to offload some of these properties before it gets even worse, only to find no one else wants them either, leaving them stuck in a big way. WeWork rents close to 20 million square feet of office space, making it a key player in the space. Its failure, get this, could be a, quote, systematic shock to commercial real estate in many American cities. It would pour more cold water over the office market, which is struggling direly. And here from a Columbia Business School professor and real estate expert, he added that has warned that the troubles in the office segment could hammer cities, spark a credit crunch, and weigh on overall economic growth. Well, of course it will, because once these loans start going bad and the banks have no mechanical way to deal with them, they're not going to lend anymore. They'll have no capacity to lend because they're already insolvent. We know many of these banks are. If they had to start dealing with this today, they would start to fail. And if you're failing, you're not lending. And all that means in a debt-based economy is less money created, or perhaps, as the M2 is suggesting, more money gets destroyed faster, and eventually you see a hard contraction in the economy and asset prices come crashing down. And yet, look at the next blow the banks are going to deal with as credit card and other car loan delinquencies pass pre-COVID levels as consumers get squeezed. Well, something that shouldn't be getting squeezed is your trading account. It should be going up in a big way, because if you signed up for CTA-Timer Pro, well, we showed you this the other day. If some people say, can you trade things like crude oil? Well, you can, because what we noted is our machine positioning showed the machines got down in this level here, and we're holding position and then started buying up right in here on this red candlestick and again on this green one. If you missed the first signal because you weren't confident and you waited for the second one, you still have booked a 15.6% gain on your trading account, which is absolutely amazing. I keep getting lots of email and feedback from people saying, look, this has changed how I trade. It's given me a lot of confidence, and it's finding a great amount of trades that I didn't have before. And here I could show you back on July 3rd, there the machine positioning started to buy if you were watching crude oil, and then again if you waited, there was the signal you needed was on July 7th. Said, look, you missed the first one, don't stress out, jump on the second one, because the difference is we run a historical overlay. It works absolutely brilliantly, and again, it'll change the way you trade. All you got to do is sign up, link in the description below, a mere $30 a month. As you can see, one trade, pay for the whole subscription for a year. And new credit card and auto loan delinquencies, this is going to be a big problem for the banks, because what happens is when delinquency rates go up, banks have to put more money in reserve, on top of the fact we know newer regulations are coming that's going to require the banks to put more money in reserve, which means less lending, and less money created. Huge problem we're seeing here. But look at these numbers. They've now surpassed pre-COVID levels. According to a Wednesday report issued by Moody's, the rate of new credit card delinquencies hit 7.2% in the second quarter, up 6.5% in the first quarter, according to the report. And here you can see what this means for retail sales, because, what do we hear from the Fed and other policymakers is this, the consumer's robust. They're going to go out and spend. They have all this money. And I want you to see that we've got this very clear indicator that retail sales growth is headed lower. We've made the case in the past that when retail sales growth slows, unemployment starts to go up, as layoffs start to increase. But I want you to see that how delinquencies have a direct impact on purchases. And here we can note that retail sales in blue shown on a year-over-year rate of change against the delinquency rate also shown on a year-over-year rate of change. And what we can note is as delinquency rates go into the plus, what happens is, of course, retail sales growth slows right down. Here you can see going in the dot-com bubble, that drove it right down. Why? Because if people are filing for or filing missing payments, they're obviously not going to be out spending because their card company's not going to give them the extra credit that they need to do that. You see it again here during the global financial crisis. Delinquency rates shot up, and of course, retail sales come crashing down. And so everyone said this can't happen again, but look at the rate of change on delinquencies. You see it has a major impact, a direct timing impact on retail sales. And of course, as long as banks keep lending standards tight and consumers find less money in the system, there's going to be more delinquencies and less retail sales. And we know that going into the holiday season, what have we seen? A bit of an increase in this economic activity. It's gotten people excited as all these things on the ships are coming over to get sold during the holiday season. And we can already see, we can predict that demand for it is going to be down. And that's going to be, again, another problem for the banks who are financing all this stuff. The rate of new auto loan delinquencies is also on the rise, hitting 7.3% in the second quarter, compared with 6.9% in the first. Auto loan and credit card delinquencies still remain well below the Great Recession levels, which they should, because even though we may be in the early stages of recession, we're nowhere near where we were at during the Great Recession, but we're going to get there. You'll see. Still, the findings suggest that more consumers are struggling to keep up with high prices, which is validating that perhaps they don't have that savings that everyone keeps saying they have. And of course, what this means is the assumption is based on the historically low unemployment rate that peaks around 5%. So Moody's is saying, look, we're calling for a recession, but this isn't going to get out of hand. Well, my friends, I'm going to show you it will get out of hand, because anytime someone mentions employment, you know what that means. We've got to pull up a chart of the 4-week moving average of initial claims and take a deeper look. And here we can see the 4-week moving average of initial claims in blue. That's shown against the delinquency rate on credit cards at all commercial banks. And sure enough, here you can see as delinquency rates shoot up and go positive, well, there go the initial claims higher. Again, this is all a function of when people are delinquent, they're not buying stuff. And when they're not buying, we need less workers. We see that again, dot-com bubble, very clear what happened there. You can see here again during the going into the global financial crisis, delinquency rates were rising, and so too did unemployment rates. And now we see all that effect again as people are telling us that these initial claims value numbers are going to come down. They're going to stay low. The labor market is strong. But if people aren't outspending money, which everyone still believes that pandemic money is just floating all around everyone's bank account, but if it was, we wouldn't see this increase in delinquencies, and it has a direct impact on spending and eventual impact on the labor market, suggesting that more people are headed out of work, which of course will mean more delinquencies. You see, it's a self-eating cycle that's bad news for the banks. And here we can see these charts now what have been leaked out of the Moody's report. This is for subscribers of the service. Now we get a snippet of what's going on. Worried about regional banks, including U.S. Bank. Could you imagine? And Fifth Third. No one would think that these banks would make the list, but they have. But a new issue may cast a pall over small and mid-sized banks. They've been forced to pay customers more for deposits at a pace that outstrips growth than what they earn from loans, which I'm going to show you. Banks kept their deposits, but they did so at a cost. This, according to Moody's, they've had to replace it with funding that's more expensive. It's profitability concern as deposits continue to leave the system, which we showed you in the show the other day. Deposits are still leaving, headed over to money markets. But just how bad is this for banks? Well, it's going to be horrible if they even survive. Shrinking profit margins along with relatively lower capital levels compared with peers at some regional banks and concern about commercial real estate defaults were key reasons Moody's reassessed its ratings on banks. In March, it placed 6 banks, including First Republic, which obviously was no surprise, under review for downgrades and cut its outlook for the industry to negative from stable. What it's going to do at some point, reduce its outlook from negative to horrific when we start to see more bank failures. And falling margins affect several banks' credit considerations. In company-specific reports this week, Moody's said it placed U.S. Bank under review for a downgrade for reasons including rising deposit costs, which I'm going to show you here in a moment, and increased use of wholesale funding, which we'll also look at. It also lowered its outlook on Fifth Third to negative from stable for similar reasons. The bank, of course, neither of them would return calls. And why would they? Because they don't want anyone to know how bad the situation is. And here we have this little leak of information out of Moody's suggesting that the problems with the banks are much worse than we think. And we know they must be because here we can see the Bank Term Funding Program. This data released on Friday shows an increased use of this lending facility from the Fed, now at $106.8 billion. And how does it cost the banks to borrow from here? A whopping 5.42%. This is very expensive money. And so you can see the banks are losing it on a big way because they've got to borrow from the Fed because that's how bad of the situation is. And you start to think about where I started the show and said, what are we doing in front of the Fed? They're going to be back at zero at some point. Well, you have to see it because as the banks start to fail, they can't pay these loans back. There's no way. And the Fed isn't going to take the collateral. We already know that. They're going to have to go back to zero. And not only that, but they've got to get the consumer to spend too. And that's not all. We aren't warning that the banking system is broken. No, we already know that it's broken. There's no surprise there. We're saying that the next 12 months to 2 years, profitability, it should be survivability, is under pressure, regulation is rising, and credit costs are rising. And here we can see the next problem the banks are facing is commercial industrial loans. And all commercial banks you see is almost near contraction, now growing at 1.7% year over year. What's nice is we get this data each week. I've been making the case this is indeed going negative. Now, what's important to understand about this chart is banks have to back those liabilities with an asset. So a liability being a customer deposit, and they need an asset, which is either a loan or some sort of debt instrument like a U.S. Treasury security. Now, the reason the banks love to back those liabilities with loans is they get more interest. But what happens when their loan book starts to contract? Well, they're going to have to go somewhere to get new assets, which means they're going to be buying treasuries in a big way at a time when nobody thinks anyone's going to want to buy them. But who's going to be big buyers? It'll be the banks, and it still won't help them at all. And here we can see another reason why the Fed is indeed going back to zero, as bankers see lower delinquency rates with easing cycle in Brazil. Now, I put this headline up to state the obvious is we're seeing, of course, this contraction or near contraction in lending from the banks. This is going to be a huge problem because that's expected then to at least go through the end of the year, because we know from the Senior Loan Officer Opinion Survey that bankers expect to keep lending standards tight, which means not a whole lot of new loans at a time when, of course, we know payments keep coming in, forcing the banks to go buy treasuries. And that means delinquency rates are going to keep going up as less money is created. And the solution, well, they found in Brazil, well, perhaps if you lower interest rates, delinquency rates will go down. Again, making the case the Fed's going to be back to zero and scrambling for a way, perhaps, to get negative. And here you can see the federal funds rate in blue shown against the delinquency rate on all loans at commercial banks. And sure enough, as the Fed cuts rates, I've got this dotted green line so you can see the baseline of where delinquency rates go from positive to negative. And so you can start to contract on a year-over-year rate of change. And sure enough, as the Fed cuts, delinquency rates shift. Here you can see again the Fed's cutting rates massively, delinquency rates shift. Here they can't go any lower. They got to do so much quantitative easing. And sure enough, delinquency rates finally come back under the contraction line. And here again, you saw it back when we were at zero, now suggesting the only path forward is when delinquency rates get completely out of control. And those are delinquency rates on all the loans. Remember, if we just looked at credit cards, that number is mega positive right now. So we know at some point to save the banking system, which is in dire shape, to keep them from closing down, to get delinquency rates down, to get consumers back to spend, there's only one path forward, and that's the Fed back to zero. But here's a problem. I don't think zero is going to be low enough. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.